Hey investor friends, I'm Michelle Markey, and if you also enjoy learning about economics and being financially knowledgeable so you can make better financial decisions, I'd love if you could please like and subscribe to my video and YouTube channel because I'm trying to encourage and increase financial literacy, and the more that we know financially, the better off we'll be. So thank you for doing that. From time to time, I like keeping tabs on some macroeconomic trends because it gives me a feel for how the US economy and world economies are doing and whether I think the economy is going in a good or bad direction, because this could have some downstream effects on the stock market. And so it's not that macroeconomic trends have a direct impact on my day-to-day investing activities, but it's just something I keep in the back of my mind and see if it has an impact or not. And so with that, I'll catch us up on the latest with what's going on with inflation and interest rates and bond yields. And I'll explain a little bit about how when bond yields go up, then prices go down. And conversely, as prices go up, yields go down. So I'll talk about a little bit of what that means and how we always hear about things like if the yield curve is inverting and what that means, and also the ongoing adventures of the Federal Reserve and Fed Chair Jerome Powell and his money printing machine. First off, I think most of us can agree that inflation has felt higher in 2021 than what it's felt like over the last several years, where it averaged maybe between 1 to 3%. And we've seen some measures of inflation like Consumer Price Index or CPI inflation reach as high as 6.2% over the last 12 months in October 2021. And there are some signs that this might be easing based on some business figures like from Costco in November. But in general, it doesn't feel like inflation is as high as some are suggesting of 15%. And let me know in the comments what you think about inflation. Do you feel like the real inflation rate is as high as something like 15%? I'd love to hear from you, but I'm not feeling much inflation to that extent. Like, I think that maybe 6% seems reasonable, but probably not way beyond 10 to 20%. I feel like that's getting a little bit up there, and I think that more people would be complaining if prices were really hiked by 10 to 20%. But who knows? Just because I'm not experiencing nearly as much inflation doesn't mean that it's not out there. So let me know if you're seeing inflation where you are. It looks more likely than not that inflation is beginning to leave more of a permanent mark on the economy because of all the labor shortages and supply chain issues we've been seeing. So Jerome Powell must be feeling the inflation pressure, since as of the Fed's FOMC November 2021 meeting, it looks like Jerome would like to retire the word transitory, which he used to mean that he believed inflation wouldn't leave a permanent mark on the economy, but it looks like it's starting to, and other people used to think that transitory meant that inflation might be short-lived, but it looks like inflation is here to stay. So I think that Jerome is actually feeling a little bit more hawkish instead of dovish, where he may be leaning more towards curbing stimulating the economy and reducing the amount of its bond purchases. So when some of the aftermath of that early November Fed meeting, it looks like the Fed might actually increase their tapering. So instead of reducing their $120 billion of US Treasury bonds and mortgage-backed securities that they've been buying ever since March 2020, they might actually increase the reduction from $15 billion to $30 billion, so that they might wrap up tapering a few months earlier than maybe June 2022. And so what that could mean is that potentially interest rates might get hiked as early as spring 2022. And some banks have kind of projected that there could be some interest rate hikes as soon as that point in time when the Fed wraps up their bond purchases. And also, the Fed isn't afraid to raise interest rates if inflation continues to remain high. And so we'll see what happens. And overall, I think a lot of economists are projecting there to be 2 rate hikes in 2022, but there could even be as much as 3 rate hikes next year. But I think that 1 to 2 rate hikes is more likely for 2022. As you probably know, the Fed has a few tools in their tool belt to be able to stimulate the economy, such as lowering interest rates, which they did during the March 2020 meltdown, where they lowered the interest rates from the range of 2.25% to 2.5% down to 0 to 0.25%. So that was a huge drop, and they also stimulated the economy by buying all the bonds that they did. And so by tapering the bonds first, that sets the stage to raise interest rates, and that's all part of the Fed's dual mandate of managing interest rates and money supply and circulation. And so let's see how they've done, because Jay Powell has admitted that they're seeing significant inflationary pressure and the economy has strengthened. So the need to do all that bond buying has actually been reduced, and they don't need to stimulate the economy as much with jobs coming back. And as part of the Fed's dual mandate, the maximum employment that they've been targeting is between 3.5 to 4.5%. And as of November 2021, we're seeing that at 4.2%. So that's actually better than the unemployment rate of 4.8% that we saw in September. And it's lower than what the Fed had been expecting as of their September 2021 FOMC meeting, where they also thought that unemployment for 2021 would be 4.8%. And then the personal consumption expenditure, or PCE inflation, they're targeting 2% in order to maintain price stability and moderate long-term interest rates. And as of October 2021, that was at 2.56%. And that's reflecting the trimmed mean PCE inflation, where they take out some of the outliers that are small and large to arrive at a mean of 2.56%. But according to the BEA, the overall PCE inflation might be as high as 5%, and that's from the Dallas Fed. So that's actually closer to what CPI inflation of 6.2% is. And overall for 2021, from their September projections, they were thinking that PCE inflation might hit around 4.2%, but inflation could be plus or minus, better or worse than that. The Federal Reserve sets the Fed funds rate, which is the rate at which banks can lend to each other. And a lot of market forces pay attention to the Fed funds rate, which, like I mentioned, is between 0 to 0.25% right now. But let's say the Fed finishes tapering their bond buying and then begin to raise interest rates as early potentially as Q3 2022, which would be starting in July 2022. And so let's say they bump it up by 0.25% to the range of 0.25% to 0.5%. And then let's see how many rate hikes they can do before that might break the camel's back, known as the stock market, because asset prices have been going up while interest rates stay low. And actually, the lower the yield, the more that markets tend to take on more risk. So it's not surprising that we've seen stock market prices kind of go pretty high for a lot of things, and some might say are overvalued. And that's why if interest rates go up higher than what the stock market and bond market might like, then we might see prices falling. And so generally, if we start seeing interest rates go up, that could also influence bond rates to also go up, making prices go down. And that's somewhat correlated to the stock market, so that as bond prices go down, so might stock market prices also. Although it's not a direct link, it may be correlated to some extent. Even though I've heard Jay Powell say that he wouldn't want to have a negative Fed funds rate, in reality, inflation is actually making the yields of a lot of assets turn negative, such as U.S. Treasury bonds. And we saw in January 2020 that the U.S. 10-year Treasury bond started turning negative to be at negative 0.02%. And it's actually been declining ever since, so much so that today, around early December 2021, it's at negative 1%. And so the spread between what the nominal or face value and the real yield of the 10-year U.S. Treasury bond is kind of significant, because the nominal or face value of the 10-year Treasury is at 1.35%. But actually investors are paying money in order for the government to borrow money from them. So it kind of doesn't make sense that someone would want to have a negative interest yielding bond, but maybe that's better to have some money loss than maybe greater losses if they were to have real negative interest rates elsewhere. But that's still somewhat of a difference from the short-term or 2-year Treasury bond of 0.6% in early December 2021, which means that these yields are not yet indicating that the markets could start declining. Whereas if bond yields started inverting, where short-term Treasury bonds would give you more money than long-term Treasury bonds, such as 10-year Treasury bonds, then markets would have something to worry about, such as when this happened in August 2019, when the bond yield started inverting. And that's called an inverted yield curve, where we saw the 2-year treasury bonds for a brief moment of a few days start being more interest bearing than the longer term 10-year treasury bond, which doesn't make sense because normally if you lend for longer periods of time, you expect to be paid higher interest rates, but that was starting to flip, and that's kind of foreshadowing markets to start falling apart. But it may not happen for a few months after a bond yield curve starts inverting, and we're not yet seeing that. And leading up to the late November 2021 decision of who would lead the Fed, it seemed like US Treasury bond yields were starting to go up, at least with 10-year Treasury bonds, until Jerome Powell was pretty much confirmed to be leading a second term in the Fed. And then after that, I guess bond yields started regressing to a lower amount for the 10-year, maybe signaling that bond markets were not fearing as much of an aggressive rate hike next year as maybe initially thought might happen. So it can be a little bit of a tricky thing trying to pair how bond yields are kind of foreshadowing what might happen with interest rates and the stock market. But for now, it kind of seems muted, as though everything is continuing business as usual. And just to quickly explain the seesaw relationship between bond yields and their prices, I like the balances example, so I'm going to borrow theirs. And let's say you have a bond A selling for $1,000 at a coupon or interest rate of 4%. So this means that bond A gives you $40 a year. And then let's say interest rates go up. And then there's bond B, which you can also buy for $1,000, and it's yielding 4.5% now, giving you $45 a year. And so in order to make bond A more attractive to people who would otherwise just go for bond B with a higher yield, the price of bond A has to go down. So in order to give the same yield of 4.5%, the price of bond A has to go down from $1,000 to $900 to give the same yield of 4.5%. And that's why as yields go up, bond prices go down, and the converse is true as well. Overall, in my humble opinion, I think that increasing inflation is eventually going to force the Fed's hand to raise interest rates, maybe sooner than they would have liked to when they originally said that they wouldn't raise rates until the year 2023. But it looks like they might have to raise rates sooner in order to curb inflation, since maybe the economy is really red hot and eventually supply issues and labor shortages will resolve. And so with that, it looks like stock market prices could be somewhat overvalued based on indicators like the Buffett indicator, which is a measure of the Wilshire total market to GDP. And that's standing at 253%, which is around 150% above fully priced that Buffett would say the market should be at technically. And then there's another measure called the Shiller price to earnings. And for the S&P 500, that had hit as high as 40 in November, and now it's around 38. So it's still kind of close to all-time highs. Like the last time we saw the Shiller PE be in the 40 range was back during the dot-com bubble. So who knows what that's foreshadowing, but I kind of think that there will be a reckoning sooner than later, and it might not be for a few years, maybe not until 2023 or 2024, but I think a market storm could be coming. So just be on the lookout for what could be happening in the economy and markets and how that might influence your investing decisions. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey to being the best investor you can be. Till next time.